now let's turn to talking about labor and wages. This will be our first case of looking at factor pricing. Factor is really just being a term that we use for anything you use to make something else. We call that a factor of production. So let's think about wages. Wages, like any price, will be determined by supply and demand. So what we really need to do is go deeper into the supply of labor and the demand for labor, and really think about what is leading to this. Now, for our purposes, we're going to make this as simple as we possibly can. If you want to make this more complicated, I'd certainly encourage you to take courses in labor economics, where you can really get into the nitty-gritty of this. So for our purposes, we're going to ignore all the taxation that happens with wages. We know that there are payroll taxes, income taxes, and the like that all would have an impact in this market. Now those we could add in later if you want to, without really fundamentally changing the story we're talking about. Another thing we're going to do is ignore benefits. I know, for example, as part of, for my job, it's actually very complicated if you look at the pay structure. Because on the one hand, I have my cash that's paid to me, with all the taxes taken out and the like. So I have this cash side of it. But then at the same time, I also have a number of benefits. So for example, the university that I work for provides a significant amount of money that heads toward my health insurance, so I get health insurance at a rather steep discount when I buy through the university's plan. I also get the same thing with life insurance. They provide a certain amount of life insurance to me, more or less for free. They provide some more that's relatively heavily subsidized, where they pay a substantial part of the cost, so it's pretty cheap for me. They also provide a certain amount of money going into a retirement plan. So there are all these benefits that we would add in. And that actually would make things more complicated too, since really what I'm paid is the combination of not just my cash salary, but something actually almost half of my pay is in the form of benefits, of the university paying for its portion of insurance and the like. Now here, it's relatively easy to get around that complication by just saying, well, the thing that we call wage is not necessarily your cash wage. It'll be the sum of your cash wage plus all these benefits added in, if there are any. So if we do that, then we're basically okay. It's not a huge problem for the theory that we're going to discuss. Now, there are little twists here and there, but once again, take labor economics if you're really interested in all of the twists. We're just trying to tell the basic story of how these decisions get made and more or less how wages are determined in the market. So, with that in mind, that we are trying to keep things relatively simple, and as a result we're ignoring a couple things that may actually be relatively important. Setting those aside, we still need to explain supply and demand, right? Here we need to remember that demand for labor really is going to come from employers. It's the employers that want to buy labor, while the supply comes from employees. Now this is something where we kind of have to change gears in our mind, because it's very easy for us to get used to thinking of ourselves as being always on the demand side, since most of the time we're out there buying things, we're consuming. When we look at factor markets, and especially labor markets, things are reversed, right? Most of us tend to be employees, so we're on the supply side in the labor market, while the businesses that we work for are on the demand side. So when we look at the demand for labor, it's really all about the hiring decision. As a business, when should I hire somebody? And there it's actually remarkably simple. And the question that I ask myself whenever I look at a particular employee, I say, can this employee produce enough to at least pay their own salary? Can they produce enough to at least pay themselves? If the answer to that question is yes, it makes sense to hire them. If the answer to that question is no, it doesn't make sense to hire them. Now here we could make this very complicated and say, well, maybe at first, before they have training, they're not going to produce enough, but if they stay on long enough, then yes, they'll end up more productive eventually, and so it makes it worthwhile. Let's keep it very simple, right? And ignore some of this training aspect and the like. We're just going to ignore that for now. Once again, take labor economics if you're really worried about that. Yeah. So, to get at this question of how productive are the employees, are they producing enough to pay for themselves, we need two new concepts. One is the MPL, or the marginal productivity of labor. The other is the marginal revenue product, or the MRP. Sometimes you'd also add an L to that, so the marginal revenue product of labor. Okay. Now, let's get into each of these. The marginal productivity of labor, or MPL for short, it just describes how much additional product or output we get when we hire an additional unit of labor. We'll get into actually doing this calculation later on. But for now, just know the formula is it's a change in quantity divided by the change in labor. So if, for example, we hire 2 more workers and they produce 50 more units, 50 divided by 2, the marginal product of labor for those 2 workers would be 25 units per worker. The marginal revenue product of labor looks at something a little bit different, where the reality is that when I'm thinking about hiring more people, I'm not so much interested in how much stuff they're producing. I'm interested in how many dollars are they going to bring in the front door. Right? So this really asks the question, how much additional revenue do I get from hiring an additional unit of labor? So when we calculate that, it's the change in revenue divided by the change in labor. Now, if we're in a market where we're price takers, that is, where we consider the price of our product to just be given, we can actually simplify the marginal revenue product in this form, where the marginal revenue product is actually equal to the price of my product multiplied by the marginal product of labor. So that's where the marginal product of labor is going to be very important, in that I have to know how much additional stuff these workers are going to produce, and then I can take that, multiply by the price, and that'll tell me how much revenue they're bringing in. So that's a nice simplification as long as the price is constant as I hire more people. So my hiring rule, then, is that I'm going to hire a laborer as long as their wage is less than or equal to the marginal revenue product for that labor. So in effect, what's going to be the case is the marginal revenue product curve is going to be my demand curve. Right? That is, it will tell me how many people to hire or buy at every single wage. So all I'm going to do whenever I look at the wage, I look at my marginal revenue product curve. As long as my marginal revenue product is above the wage, I hire that person. If it's still above the wage for the next person, I hire them too. The next person, I hire them too. And I stop as soon as the marginal revenue product hits the level of the wage. Right? So the marginal revenue product curve tells me how much to buy. That's exactly what a demand curve does. So it really is the same thing. Here's a mathematical case. Let's work out some of this example. Okay, so here I have the quantity of labor furthest left, then the quantity of product that they produce is the next one. Then we have the marginal product of labor. We can calculate revenue. We can calculate marginal revenue product then. We can look at the amount of cost we have and the profit. To keep things simple, we're just going to say that first we're price takers. We'll set the price equal to $1. That makes life easy. We'll assume that labor is our only cost, so we don't have to worry about materials. So this is something that labor alone can produce. I can't think of any good examples because there really aren't any that I know of. But just to keep things simple, let's work with it that way. So labor is the only cost we're worried about. That'll make it easier for us to calculate cost and profit. And let's say the going wage right now is $15, as you can see typed up on the slide. So if you want to go ahead and try this, you can. I'll work the first line for you here in a second, just to give you an example to get you started, and then go ahead and try and fill in the rest yourself. Okay. So here's the first line. If we look at the marginal product of labor, remember that's just the change in product divided by the change in labor. If we look from the first line where we're producing nothing to the second line where we're producing 20 units, change in product is 20. At the same time, our change in labor is just 1. 20 divided by 1 is 20. Now, revenue in the first line is naturally going to be 0. If we're not producing anything, we don't bring in any revenue. At the same time, if we don't hire anyone, our cost is going to be 0. So a profit of 0 is what we have there in the first line. Now, in the second line, where we've actually hired a worker, we're now producing 20 units, selling them for $1 a piece. That's $20. Our cost is $15 because we have to pay that one laborer $15, leaving then a profit of $5. Marginal revenue product, we see there's 20. We could get that one of two ways. We could either take the marginal product of labor and multiply by the price, so 20 times 1 is 20, or we could look at the difference in revenue, 0 to 20, and divide that by the difference in labor, 0 to 1. 20 divided by 1 is also 20. Either way will get you to the marginal revenue product. Now go ahead and fill in the rest, and I'll be with you in a second to check your answer. You should have ended up with something like this. Right? So you fill in the rest, you find out the marginal product of labor, it looks like the marginal product of labor is dropping by 2 with each line. Right, so it goes from 20 to 18 to 16 to 14 and so on. This is really just diminishing returns worked out. Right, so we know eventually as you hire more people, you're going to have to put them in doing less and less productive things, to the point where it's even possible if you hire enough people, they start getting in the way, and you're actually worsening your production by hiring more people. Now we want to look for where the profit is greatest, and you see that's already there circled in red, or I guess rectangled in red. there it looks like the greatest profit we can earn is $9, and that's also exactly at the point where the wage would cross our marginal revenue product. Marginal revenue product above that line is $16, below that is $14. So $15, our wage, is right there in between. Right? And that just happens to be exactly where the profit is. That isn't actually an accident whatsoever. This rule, you hire people as long as their marginal revenue product is above the wage, actually ensures that you're going to hire the right number of people, right, in terms of being able to maximize your profit. Right? That rule is really based around, as long as I'm doing this, I'm going to be more profitable. Once I start hiring people that cannot pay for themselves, I'm going to end up less profitable. So it's purely from the logic of it. So here we've seen it work. Marginal product of labor, the marginal revenue product, and shown how the marginal revenue product relates to our demand for labor and our willingness to hire labor. Now, here in the next video, we're going to look at some of the changes that can happen that would result in us changing the number of laborers we want to hire and how that happens.